Hello, everyone, and welcome to Market Week in Review for the week ending May 2nd, 2025. My name is Bei-Chen Lin. I'm a senior investment strategist and head of Canadian strategy here at Russell Investments. On this week's edition of Market Week in Review, we'll be discussing three major topics. First, what should investors know about U.S. GDP activity in the first quarter and why we think the U.S. economy was still relatively resilient despite this news? Second, we'll talk a little bit about some of our watch points going forward and why do we think economic uncertainty continues to remain elevated. And finally, we'll wrap up with a discussion of why we think diversification continues to be so crucial. So let's get started. In terms of the U.S. GDP, the latest data from the Bureau of Economic Analysis suggests that the U.S. GDP actually shrank in the first quarter, contracting at an annualized pace of 0.3%. Now, this was the first contraction since 2022. And while ordinarily a contracting GDP would imply economic softness, I think it's important to note that this time around, there might have been some special factors at play. We know that the US government decided to impose tariffs on a wide variety of imports. And likely one of the things that happened is, ahead of that tariff imposition deadline, some consumers and businesses likely decided to accelerate or pull forward their imports. And because of that, we actually saw imports rise during the first quarter. And that surge in imports likely weighed down on the overall headline GDP numbers. When we look at other components within the GDP report, for example, personal consumption expenditures or private domestic final demand, those two measures suggest that U.S. economic activity was actually still quite resilient in the first quarter. And when we look at things like earnings, for example, S&P 500 companies generated earnings growth of around 13% year over year in the first quarter, which is above the longer-term average earnings growth rate of around 8%. In addition, the unemployment rate remained relatively low in the first quarter as well. And so we have all these signs that still point to economic resilience in the first quarter. Now, one of our key watch points then is what happens in the second quarter, and the third quarter, and the fourth quarter of this year. And this is where I think it's important to highlight this hard data versus soft data divergence. So when we look at the hard data, like the earnings numbers, like the layoff picture, that suggests that the US economy has still been robust. But when we look at the soft data, which is things like surveys and sentiment, that suggests that people are getting a little bit more worried about the economy. So for example, the Conference Board's measure of consumer confidence, that fell to a 5-year low, and that mirrors a similar story from the University of Michigan's Consumer Sentiment Survey, which also fell to some relatively low levels in its longer-term history. So there are some signs that consumers are getting a little bit more worried, and the key question going forward is, what do consumers do if they get more worried? Do they end up still spending, or do they end up pulling back on some of their spending? Because if they do pull back on spending, then that can potentially adversely impact business profit margins and could lead to a cycle where ultimately we see the number of layoffs rise. And so there is a lot of uncertainty going forward. And in fact, some companies in their earnings reports even decided to suspend forward-looking guidance because there's so much uncertainty in the economic picture. Now, one of the continued watch points going forward is going to be what happens with the tariff situation, and we do continue to think that there is a strong case to be made that the U.S. government is likely using these tariffs as a form of a negotiating tool. And in fact, we've even heard some statements out of the U.S. government this week that they were optimistic that perhaps there could be some trade deals that would be reached within the next couple of months from now. But it is a watch point going forward, and we do need to continue to monitor that situation very carefully. We continue to think that economic risks remain above average, and in fact, we think the risk of the U.S. economy tipping into recession is higher than the longer-term average. We think that the risk of the U.S. economy tipping into recession over the next 12 to 18 months is about 40%. And we think that the cyclical risks might be even higher outside of the U.S. So how should investors navigate this uncertain environment? We continue to think that diversification remains a powerful tool. To give you an example, even though we think that cyclical risks are higher outside of the US, we think that equity valuations in places like Canada or Europe are actually better than equity valuations in the US. And I think that's one of the reasons why you've actually seen equities in those regions outperform US equities despite the higher cyclical risks. We also saw infrastructure, a very defensive asset class, outperform traditional equities year to date. So I continue to think having a well-diversified portfolio is going to be crucial. Thanks for tuning in, and we'll see you next time.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.